I already said it this morning. I told you to go enjoy your families. I told you to shut off the screens, and honestly, I meant to do the same. I was sitting there with a glass of wine trying to tune out the markets for 12 hours, but I wouldn't be turning this camera back on right now if this weren't an emergency. I need you to put down the eggnog for a few minutes. I need you to step away from the noise and focus on the hard data that just landed on my desk from the other side of the world. The Chinese silver market just sent a warning that's impossible to shrug off. This isn't a chart guess. This isn't a maybe. This is a mathematical crack in the global financial system. Ladies and gentlemen, an Asian commentator here. I want you to look at the number I'm about to put on the screen, $8,053. That's not a typo. That's not a clickbait thumbnail. That's the real confirmed price of physical silver in Shanghai right now. More specifically, it's the settlement price for the Shanghai Futures Exchange SHF front month contract, a 2,601, which closed at $18.145 UN per kilogram before their holiday break. I'll link the source in the description if I remember. Now look at the price on your broker app here in the US, $71.80. See the issue, that's a gap of $927 per ounce. In professional trading, we don't call that a spread. We call that a market that's malfunctioning, and I know the skeptics are watching. I know the trolls are already typing. You're making up numbers. So let's run the math together. Grab your calculator. I'm using the official settlement data from SHFE and the current USD-CNY exchange rate of 7.006. Step 1, take the Shanghai price 18,145 UN per kilogram. Step 2, convert it to US dollars, $18,145, divided by 7.66, equals $2.589.92 per kilogram. Step 3, convert kilograms into troy ounces because silver is priced in troy ounces, not standard ounces, not 35. There are 32.15 ounces in a kilo. Step 4, $2.589.92 divided by 32.15 equals $8,055 per ounce. The math doesn't lie. The biggest manufacturing economy on Earth, the one that actually consumes silver for solar panels and EVs, is pricing the metal at $80. Meanwhile, the paper market in New York, where bankers trade digital IOUs, is acting like the price is $71, and why is that terrifying for the banks? Because in a normal functioning market, that kind of gap shouldn't exist. If silver is $9 cheaper in New York, every bank, hedge fund, and algorithm on the planet should be buying in New York, flying the metal to Shanghai, and selling it for a risk-free $9 profit. That's arbitrage. It's the force of gravity that normally keeps global prices tied together. Most of the time, the spread is 50 cents, maybe $1 in extreme volatility. But $927 means the gravity switch got flipped off. It means the arbitrage machine is failing. So why aren't the banks closing this gap? Why aren't they buying cheap silver in New York? There's only one logical answer. They can't. They can't move the metal because the metal in New York either isn't there to move or the logistics chain has buckled under the weight of Eastern demand. What we're seeing is a market where the paper price and the physical price have officially split up, and that's why I interrupted your Christmas. Tomorrow morning, the U.S. markets reopen for what we call Ghost Week, the low-volume, illiquid trading days between Christmas and New Year's. You've got a New York market with basically no liquidity, and you've got a $9 vacuum tugging the price upward toward Shanghai. Nature hates a vacuum. That gap has to close. And since China isn't going to cut their price when they're dealing with a shortage, New York has to move higher. We're staring straight at the possibility of a huge gap up when the algorithms wake up and realize how mispriced they are. I'm going to lay out exactly why this premium exploded. We've got reports that specific industrial sectors in China, solar and EV, are panic hoarding metal no matter what it costs. Why is China willing to pay $9 above the global spot price? Why aren't they waiting for the price to cool off? Why are they buying aggressively at all-time highs? If this were a speculative frenzy like GameStop or crypto, you'd see retail traders chasing a chart. But the volume we're seeing on the Shanghai Futures Exchange isn't coming from retail accounts. It's coming from commercial hedging accounts. The whale buying silver in China right now isn't a hedge fund. It isn't a bank. It's the factory floor. We're watching an industrial run on the bank, and unlike a financial run where people just want their cash back, an industrial run is about survival. If you don't get your metal, your factory stops, your workers go home, and your company collapses. That's why they're paying $80, because the alternative is zero. Now let's talk about the first driver, the one everyone mentions, but almost nobody understands the sheer scale of solar photovoltaics PV. China controls over 80% of the global solar panel manufacturing supply chain. For years, Western analysts said, don't worry about silver demand. Solar companies will thrift it away. They'll use copper. They'll use less silver paste. That storyline just died. I've got a report here from the China Photovoltaic Industry Association, CPIA, released right before the holiday, showing that despite silver's high price, silver consumption per watt has stopped declining. They've hit the thrifting wall. You can't cut the silver content any further without sacrificing panel efficiency. And here's the kicker, TOPCon technology. The industry is shifting fast from the old PERC cells to the new TOPCon and 8JT cells. These new high-efficiency panels require 50% to 80% more silver than the old ones. So at the exact moment global mine supply is flatlining, the Chinese solar industry has realized they need more silver per unit, not less. We're seeing verified reports out of the Jiangsu province, the heart of solar manufacturing, that factories are skipping the standard supply chains. They aren't waiting for deliveries from refiners. They're going straight to the Shanghai exchange and taking delivery of 15 kilograms bars. They're melting down investment-grade bars to turn them into industrial paste. This isn't normal. This is desperation. This is a sector looking at 2026 like a year of famine, and they're clearing the shelves before the year even begins. But if solar were the only driver, we might be able to absorb it. The real panic, the reason the premium blew out to $9 this week, is coming from the electric vehicle sector. We need to talk about the Samsung shock. Earlier this week, reports circulated about the mass production timeline for Samsung's new solid-state batteries. These batteries are a game-changer, 600-mile range, 9-minute charge time. But the anode isn't graphite. It's a silver-carbon composite. The specs are brutal on the supply side. A standard EV uses about 20 to 50 grams of silver for contacts and switches. A solid-state EV uses up to 1 kilogram, 1,000 grams of silver. That's a 20 to 50 times jump in silver consumption per car. Now connect that to China. China is the world's largest EV maker, BYD CL Neo. Do you really think they're going to let Samsung corner the next generation of battery tech? No. We're seeing massive block buys of silver originating from Shenzhen and Ningde, where CL is headquartered. These companies aren't building solid-state batteries today, but they're strategic hoarders. They know that if they want to build millions of these cars in 2027, they have to secure the silver now. They're treating silver the way the market treated lithium in 2021. They're trying to lock up the entire mine supply before it even comes out of the ground. They're treating silver the way the market treated lithium in 2021. They're trying to lock up the entire mine supply before it even comes out of the ground. When BYD buys silver, they don't buy 5,000 ounces. They buy 5 million ounces and their price inelastic. When BYD buys silver, they don't buy 5,000 ounces. They buy 5 million ounces and their price inelastic. They don't care if it's $70 or $80. They care about locking up the supply chain to crush their competitors. So we've got solar panic and EV hoarding. What does that do to inventory? Look at the Shanghai Futures Exchange SHF warehouse stocks. In 2021, these warehouses held over 3,000 tons of silver as of the December 23rd close. Now they're down to less than 800 tons and still dropping. That's a 75% drawdown in visible inventory. But the registered warrants, the metal available for immediate delivery, are even lower. It's basically zero. That's why we're seeing backwardation. Backwardation is a fancy term that means I'll pay you more for metal today than for metal next month. Normally, futures prices are higher because storage costs money. But right now in China, the spot price is trading meaningfully above the futures price. The factories are screaming, "Don't promise me metal in February! I don't believe you! Give me the metal today!" Backwardation is the heartbeat of a squeeze. It's the market telling you there's a physical shortage at the current price level. Now look back at the West. Look at the comics. The traders in New York are staring at charts. They're watching the dollar index. They're drawing Fibonacci retracements. They have no idea what's happening on the ground in Jiangsu. They think silver is a currency. China understands silver is a strategic technology metal. The West is selling paper silver at $71 because they think it's expensive. The East is buying physical silver at $80 because they know it's cheap compared to the cost of shutting down a gigafactory. This is the great wealth transfer. Every ounce dumped on the comics at $71 is getting sucked up, refined, and shipped into a Chinese warehouse where it may never be seen again. So what happens tomorrow morning when Ghost Week begins? You've got a New York market with almost no liquidity. Bankers are skiing, there's no inventory. ASA drained 1.4 million ounces, there's a $9 price gap with Shanghai, and now you know who's on the other side of that trade. It isn't a speculator, it's BYD. It's solar giants. They're not going to stop buying just because it's Christmas. Their factories run 24/7. If a Chinese industrial buyer decides to hedge their January production tomorrow morning, they'll hit the comics ask button. And because the order book is thin, the price can jump from $72 to $75 to $78 in the blink of an eye. They'll close the arbitrage gap by force. This premium explosion in China isn't a glitch. It's the sound of the industrial supply chain snapping. The factories have done the math. They know there isn't enough silver for solar, EV, AI, and investment demand. So they're playing musical chairs, and right now China is buying all the chairs, and there's a massive hole in this story we still haven't addressed. It's the question every professional trader is asking right now. If there's a $9 profit on every single ounce of silver, why isn't anyone taking it? Think about how Wall Street operates. These are the greediest, smartest, fastest institutions on the planet. They have supercomputers built to scalp fractions of a penny in microsecons. If they see an asset trading at $71 in New York and $80 in Shanghai, their instinct is to close that gap. They should be buying every bar in the COMEX vaults, chartering cargo planes out of JFK, and dumping silver into Shanghai until prices match. It's literally free money. It's a risk-free trade. So why is the gap getting wider? Why has it moved from $2 to $5 and now to $9? The answer is terrifyingly simple. They can't move the metal. We're watching a catastrophic breakdown in the physical logistics of the silver market. The arbitrage mechanism, the engine that keeps global prices synchronized, has seized up because the fuel is gone. You can trade paper contracts in milliseconds, but you can't teleport a 1,000-ounce bar of silver. You have to physically source it, load it, insure it, and fly it, and right now that supply chain is broken. We've spoken to sources in the logistics industry, specifically those dealing with secure air freight out of London and New York. They're reporting a complete blockade. It's not that planes aren't flying, it's that the metal isn't showing up at the loading dock. The bullion banks are trying to source the metal to run this arbitrage trade. They're calling the vaults. They're calling the refineries, and for the first time in decades, they're being put on a wait list. The refineries are telling them, we're booked solid for 6 weeks. The vaults are telling them, we need 48 hours to locate that specific bar serial number. Locate the serial number. In a digitized, modern vaulting system, you should know exactly where every bar is down to the millimeter. When a vault operator says they need time to locate your metal, it means one thing. The metal isn't where it's supposed to be, or worse, it's been rehypothecated, leased out to someone else, and they're scrambling to find a replacement before you notice. Which brings us to the smoking gun. The hard data that proves Western vaults are being drained of their last deliverable ounces. While everyone was distracted by the holiday shopping rush, the COMEX released its inventory report for December 23rd. This is the last official data point we have after the Christmas break. Which brings us to the smoking gun. The hard data that proves Western vaults are being drained of their last deliverable ounces. Which brings us to the smoking gun. The hard data that proves Western vaults are being drained of their last deliverable ounces. While everyone was distracted by the holiday shopping rush, the COMEX released its inventory report for December 23rd. This is the last official data point we have after the Christmas break. And it's absolutely critical you understand what it shows. In a single day, the Asahi refining vault in New York saw a withdrawal of over 1.4 million ounces from its registered category. Let me say that again, 1.4 million ounces gone in 24 hours. Now you need to understand the difference between eligible and registered. Eligible silver is just sitting there. It could be owned by a private collector or a family office. It's not necessarily for sale. But registered silver, that's the lifeblood of the exchange. That is the metal that is fully warranted, available for immediate delivery to settle a futures contract. It's the for-sale inventory of the entire market. When you see 1.44 million ounces leave the registered category at Asahi, plus another 600,000 ounces leave the JP Morgan vault, plus another 200,000 ounces leave the CNT vault, all in the same day, you're watching a bank run. You're watching the smart money rush for the exits. These entities, and we strongly suspect they're linked to the Asian industrial buyers we discussed in Part 2, aren't playing the paper game. They aren't hedging. They're taking possession. They're backing a truck up to the loading dock in New York, loading it with 1.44 million ounces of physical bars and driving away. And that explains why the arbitrage gap won't close. The inventory the banks would normally use to ship to China is already being taken by the Chinese. It's a paradox. The same demand that's pushing the price to $80 in Shanghai is also sucking inventory out of New York, making it impossible for the banks to execute the arbitrage that would normally pull prices back down. It's a death spiral for the COMEX. The higher the premium rises in Shanghai, the faster metal leaves New York. The faster metal leaves New York, the less liquidity there is to manage price, and the less liquidity there is, the more the price disconnects. We're also hearing rumors, and I want to stress these are currently unverified reports from floor traders in London, that the LBMA, the London Bullion Market Association, is facing administrative delays, processing large-scale allocations. Normally, if you have an unallocated account and you request your bars, it takes a few days. We're hearing reports of delays stretching into weeks. If London is out of metal, then the game is over. London is the main hub. It's the vault of last resort. If the London float is gone, then the COMEX is just an island. It's a paper market trading a derivative of a ghost. That's why Ghost Week starting tomorrow is so dangerous. We've got a New York market that's been hollowed out. Registered inventory is dropping toward historic lows. The float, the truly available metal, is razor thin, and tomorrow morning the electronic markets flip back on. There's a $9 incentive for anyone holding physical metal to sell it in Shanghai, but there isn't metal left to ship. So if you can't ship the metal to close the gap, what's the only variable that can adjust? Price. The New York paper price has to rise to meet reality. It can't sit at $71 while the physical world is transacting at $80. The math just won't tolerate it. The banks are trapped. They're short paper contracts in New York, but they've lost control of the physical inventory. They're like a poker player who bet the house on a bluff. Then the other side turns over a royal flush, and that other side is China. China isn't bluffing. They're taking the chips, they're taking the table, and they're taking the metal. We're witnessing the end of the paper price era. For 50 years, New York told the world what silver was worth. Today, that authority has been revoked. The prices being set on the loading docks of Shanghai and New York is just a lagging indicator. Now we need to talk about tomorrow morning, December 26th. We're about to watch a collision between two forces, the liquidity vacuum of Ghost Week and the price magnet of the $9 Shanghai premium. Normally when those forces collide, you get volatility. But this time, because the physical bridge is broken, we may get something much more dangerous, a super gap. First, let me lay out the battlefield. Tomorrow morning, 90% of the senior traders at JP Morgan, Goldman Sachs, and HSBC are on vacation. They're in Aspen. They're in the Hamptons. Their desks are being run by skeleton crews, junior traders, and automated maintenance algorithms. That means the order book is paper thin. On a normal day, there might be 500 contracts for sale at $71.50. Tomorrow, there might be 50. That's the liquidity vacuum. It takes very little money to move price a very long distance. Now enter the high-frequency trading HFT algorithms. These bots don't know it's Christmas. They don't know Asahi is empty. They only know math, and the math they're staring at is screaming. The algorithm sees asset A, Shanghai, $8,053, asset B, New York, $7,126, instruction by asset B until price A equals price B. Normally, a human would step in. A human would say, wait, we can't ship the metal, so don't buy. But the humans are skiing and the algorithms are running on autopilot. So tomorrow morning when the Shanghai market opens and confirms that $80 price, the New York algorithms are going to try to close the gap the only way they know how, by bidding up the paper price. Here's how the squeeze happens, step by step. The trigger, a Chinese industrial hedger like BYD or a solar company, places a large buy order to secure inventory. They don't care about the holiday. They need metal. The vacuum that order hits the comics, but because it's Ghost Week, there are no sellers at $71.30, no sellers at $71.40. The order slips instantly to $72, just to fill the first few contracts. The algo chase HFT bots see the jump. They see the $9 premium. They calculate an arbitrage opportunity and they pile into the air pocket. Suddenly you've got massive buying pressure hitting an empty room. The price doesn't tick higher, it gaps. It skips $73. It skips $74. It prints $75 within minutes. That's what we call an air pocket because the physical arbitrage shipping metal is broken. The only way to close the spread is for the paper price to teleport upward to meet the physical price. But it gets worse for the banks. We also have to talk about gamma. There are thousands of call options open at the $72 and $75 strikes. The banks sold these options to speculators. If price gaps to $75 tomorrow, the banks are offside. They're losing money. To protect themselves, they delta hedge. The bank's automated risk engine has to buy futures. So as price rises, banks are forced to buy more to hedge their losses. But that buying pushes price higher, which forces them to buy even more. It's a feedback loop from hell, and it's happening in a market with no inventory to slow it down. You might ask, but won't people sell at $75 to take profit who the miners aren't selling, they're holding back supply? The Chinese aren't selling, they're hoarding. The vaults are empty. The only people who might sell are retail traders like you. But are you going to sell your silver at $75 when you know it's trading at $80 in China? No, you're going to hold. You're going to wait for $80. So sellers go on strike, buyers panic, and the algorithms chase the ghost. So here's what you need to watch for tomorrow morning, December 26th. Don't look at the news, watch the spread. If New York opens flat at $71, it's a trap. The explosion is just delayed until volume returns on January 2nd. But if New York opens at $73 or higher, the squeeze has begun. If we break $72.50 in the first hour of trading tomorrow, the air pocket is active. We could see a move to $78 before the lunch break. The market is trying to tell you something. It's telling you the discount window is closing. The $71 price is a lie. The $80 price is the truth, and the lie is about to be corrected violently. Let's assume the squeeze happens. Let's assume the Ghost Week gap closes and New York wakes up at $80. The skeptics will say, okay, that's it. The bubble is over. Sell everything and go home. They're wrong. They're fundamentally misreading what's happening. $80 isn't the ceiling. It's the new floor. What we're witnessing right now, this violent decoupling between East and West, isn't just a trade. It's the end of an era. It's the end of the Western discount. For 50 years, New York and London determined the price of silver. They used paper contracts to keep the price convenient for Western banks. But today, with Shanghai trading at $8,053, that era is officially finished. Pricing power has shifted east, and China isn't trying to manage the price. They're trying to secure the metal. Once New York capitulates and matches $80, the suppression mechanism breaks for good. To understand why price pushes higher than $80, you have to understand the mindset of a CEO. For the last 30 years, global industry ran on just-in-time inventory. If you were Samsung or Tesla or a solar manufacturer, you didn't stockpile silver. You trusted the market. You trusted that if you clicked buy on Tuesday, the metal would show up on Wednesday. But what happens when the premium hits $9? What happens when vaults run dry? Trust evaporates. We're shifting from just-in-time to just-in-case. Every industrial CEO looking at this $9 spread is thinking the same thing. If I don't buy 6 months of inventory right now, I may not get it later. That creates a hoarding supercycle. It doesn't matter if the price is $80. If you're building a $50 000 electric car and it needs $80 worth of silver, you pay it. If silver goes to $150 and that car now needs $150 worth of silver, does that kill demand? No. It adds $70 to the cost of a $50 000 car. It's irrelevant to the final sticker price, but critical to the product's function. Silver is inelastic, and in an inelastic market, when confidence breaks, the price doesn't just double, it adds a zero. Now let's talk about the banks, the paper masters. Their entire game relied on one bluff. If you buy futures, we can deliver the metal. The $80 Shanghai price calls that bluff. If the banks try to short silver at $80 to cap price, the arbitrage bots will just buy their paper, take delivery, and ship it to China. The banks can't suppress price anymore because they'll bleed physical metal instantly. This means the cap is gone. The artificial ceiling that held silver under $30, then under $50, has been ripped away. We've entered pure price discovery, and in price discovery, price has to climb high enough to do one of two things. Crush demand. Make it too expensive for Samsung to use or pull new supply online. Make it worth opening new mines. Let's talk numbers on demand destruction. Solar and tech need silver. They can't just swap it out. So demand is sticky. On the supply side, it takes roughly 10 years to permit and build a new mine. Even if silver hit $200 tomorrow, meaningful new supply doesn't arrive until 2035. So for the next decade, price has to do the heavy lifting. $80 is only the alarm bell. $125 to $150 is the kind of equilibrium needed to balance the deficit. So here's my forecast for the new reality of 2026. We're going to watch a bifurcated market dissolve into a single bull market. Right now we have two prices, $71 and $80. By January, we'll have one price, $80 plus. Once that merge happens, Western investors, pension funds, retail stackers, the sidelined capital will finally accept the shortage is real. They've been waiting terrified of the classic bank smackdown, but when they see the banks can't lean on it anymore, when they see $80 hold as support, money floods in. You've got industrial panic as the floor, logistics breakdown as the catalyst, a squeeze as the accelerator, and then investment FOMO as the rocket fuel. That's a setup for a move that makes 1,980 look like a rehearsal. But there's a danger here. Not a price crash danger, a psychology danger. When silver prints $80, your brain will scream too high. Sell, take profits. You've been trained to think $30 is high. You've been trained to believe $50 is the top. You have to rewire that instinct for the new regime. In a world where the dollar is dying and China is paying $80 for a strategic metal, $80 isn't expensive. $80 is the new $20. If you dump at $80, you're swapping a scarce strategic asset for a depreciating paper currency. Right as the asset is about to go vertical, you're selling your seat on the lifeboat at the exact moment the ship starts to tilt. So the squeeze is inevitable. The gap closes. The price resets. The question isn't if. The question is, how do you make it through? How do you survive a market that swings $5 a day? How do you avoid getting shaken out by volatility? How do you protect your stack when dealers run dry? I'm going to share 3 specific strategies for the retail investor to maximize this opportunity without getting wrecked by the chaos. The easy money has been made. Now comes the hard money, the volatile money. When silver was boring at $25, it was easy to hold. You bought it and forgot about it. But next week, when silver is whipping between $72 and $80, when your portfolio is swinging by tens of thousands of dollars in an hour, that's when mistakes happen. That's when weak hands get shaken out. That's when the banks try to steal your position one last time before the real move into triple digits. The biggest enemy you face right now is your own brain. Your brain is anchored. For years, you've been conditioned to believe $30 is expensive and $50 is the moon. So if we gap up to $80 next week, your brain will scream, sell, take the money, this is a bubble, and you have to silence that voice. You have to understand the dollar price is a lie. If you sell your silver at $80, what are you getting back? Fiat currency. A currency, the Federal Reserve, has essentially admitted they must debase to save the debt market. A currency China is actively dumping. If you trade a scarce strategic asset silver for a depreciating liability dollars, you aren't taking profit. You're jumping off the lifeboat and swimming back to the Titanic. Stop staring at the dollar price. Start watching the gold to silver ratio. Right now the ratio is around 60 to 1. Gold is roughly $4.200. Silver is roughly $71. Historically, in a true monetary reset or a supply crisis, that ratio compresses to 15 to 1. Until silver reaches 1 over 15th, the price of gold, it's fundamentally undervalued. Don't even think about selling until the ratio is screaming at you. $80 is not the signal. Next week, during Ghost Week, the volatility is going to be nauseating because liquidity is so thin. We could see a flash crash. We could wake up Tuesday and see silver down $4 in a single minute because an algo dumped a block of futures. The media will scream silver crash bubble burst. The spot price on your phone will flash red. Ignore it. Remember the Shanghai price. Remember the industrial panic. If spot drops to $68 on your screen, ask yourself, can I actually buy physical metal at $68? Check the online dealers. Call your local coin shop. I guarantee you they won't be lowering their prices. They'll be raising their premiums. They know the physical market is broken. If the paper price crashes, it's a gift. It's the fake price separating from the real price. Don't get stop-lossed out of your position by a paper game. If you hold physical, you're insulated from the flash crash. You hold the ounces, not the contract. If you hold miners or ETFs, keep your conviction. The paper price has to reconnect with physical reality, eventually $80 plus. That's the most practical advice I can give you. We're rapidly approaching the point of unobtainium. Oh, and as the arbitrage gap widens, the flow of metal from west to east is accelerating. We're hearing major U.S. dealers are already running low on 100-ounce bars and sovereign coins, eagles, maples. There's a very real possibility that in January 2026, the buy button disappears. You'll go to a website and everything will be out of stock or pre-order only with a 6 to 8 week delay. When that happens, the price on the screen becomes irrelevant. It doesn't matter if spot is $80 or $100 if you can't buy any. The strategy is simple. If you have cash on the sidelines that you intend to put into silver, do it now. Don't try to time the dip next week. Don't try to save 50. Secure the ounces while they're still available for immediate delivery. Because once the Ghost Week gap hits, and headlines break about the $80 Shanghai price, the retail stampede will wipe out the remaining inventory in 48 hours. I want to close this series with a thought about why we're doing this. It isn't just about making money. We're living through a historic pivot point. For 50 years, the Western financial system used paper derivatives to suppress the price of real assets. They kept silver cheap to subsidize their industries and their currencies. But the East, China, India, Russia, the BRICS has called the bluff. They're draining the vaults. They're demanding physical delivery. They're forcing the world back to a system based on reality.